So, these traditional stock prediction methods, relying on historical industry groupings, seem pretty simplistic, right? They just can't account for those sudden shifts in investor sentiment or the real-time, almost instantaneous reactions to news.
Exactly. And that time-delayed correlation, where one stock reacts before another, completely throws them off. It's like trying to catch lightning in a bottle. You need something that's nimble enough to respond to the unpredictable flashes.
So, these traditional methods relying on these static industry groupings are fundamentally flawed, aren't they? They miss the mark on real-time interactions and the sudden shifts that truly drive stock prices.
Absolutely. It's like trying to predict the weather with yesterday's forecast. The market is constantly evolving, and these methods just can't adapt fast enough to those fleeting, unpredictable connections. It's a recipe for missed opportunities and potential losses.
Exactly. And isn't the whole issue of manual feature selection a huge problem? Trying to pick the right features is an art form, and constantly needing to tweak them for different market cycles just isn't practical in today's dynamic environment.
You've hit the nail on the head. Manually selecting features is a time-consuming, resource-intensive task. It also introduces human bias and can lead to outdated models. We need something that automatically finds those hidden connections.
So, these static rules about industry groups just don't cut it, do they? Two tech companies in the same sector can react completely differently to the same news. One soaring, the other plummeting. It's all about those unpredictable, real-time factors.
Precisely. And it's not just about immediate reactions. Imagine a new company IPOing. Instantly, its correlation with other stocks shifts. Static models are hopelessly outdated by the time they register such a fundamental change. We need a system that's truly fluid and responsive.
Exactly. And then you have the issue of real-time flexibility. These traditional models, looking at long historical periods, are like trying to predict a hurricane with a weekly weather report. They miss the crucial details of the storm's dynamics, the sudden shifts and quick changes.
You are absolutely correct. A time-sensitive, news-driven event can cause a huge divergence. A market reacting to a resource shortage, for example. We need a method that recognizes those immediate responses and not just the overall trends. It has to see the lightning strike, not just the overcast sky.
So, these traditional models completely miss the mark on how stocks react in a real-world supply chain, right? Upstream companies can react instantly to news, but downstream ones lag behind. That time offset, or lead lag effect, is crucial but lost in the average.
Precisely. Think of a chip shortage. The semiconductor manufacturer's stock might jump immediately, but companies relying on those chips might see a price drop only days later. Traditional models, averaging everything out, simply can't capture that vital dynamic. It's like trying to understand a river's flow by only looking at the average speed and ignoring the rapids.
And what about external shocks? A natural disaster or sudden policy change? These static models just get washed away by the wave, aren't they? They can't adapt fast enough to the unexpected shifts in correlation.
Absolutely. A policy announcement can send ripples through entire sectors. One company might plummet, while others barely flinch. These static models are too slow and rigid to follow those swift, unpredictable shifts. It's a total blind spot.
In the manual feature selection? Doesn't that further compound the problem with these static models? Since the relevance of certain factors shifts dramatically depending on the market situation, it's a constant game of catch-up.
Exactly. What's relevant in a roaring bull market is completely different from what's important in a turbulent bear market. You're stuck with these older, perhaps even useless features, when you could be using the latest indicators and news insights. It makes the process almost pointless, doesn't it?
Right? So these hand-picked features like moving averages, they're good sometimes, but they're not adaptable. A bull market makes trading volume key, but a bear market needs more fundamental analysis. It's like constantly retuning a radio to catch a fleeting signal.
Precisely. It's a huge time sink, and you risk missing crucial signals if you don't update your choices. Plus, who has the time and the expertise to constantly reevaluate for different market phases? And what about introducing bias during this manual selection? It's just a recipe for disaster.
And it's not just the labor-intensive nature. It's also the risk of using outdated or useless signals. A feature that was great in a quiet market becomes totally irrelevant in a crisis. You're just relying on yesterday's news.
Absolutely. Imagine using a 1950s map for a modern city. You're just going to get lost and end up in the wrong place, right? That's what we're doing with static features in a rapidly changing market. We need something proactive and automatic. A system that knows what signals are useful now.
Exactly. We need a system that doesn't just look at the past, but that looks at real-time data. Something that can automatically identify what matters today. Imagine a dynamic system that would understand if it's a bull or bear market and adjust its focus accordingly.
Right? A system that can understand the current market mood, the prevailing sentiment, and choose features based on that in real time. That would be revolutionary. It could even adjust the importance of features if the market volatility changes, picking out the most important factors.
So, this dynamic model sounds like it's actively watching the market, adjusting its approach in real time. That's a massive leap forward, isn't it? It's not just looking at historical averages, but at instantaneous connections.
Precisely. Imagine a model that can adapt to a sudden surge in volatility. It would immediately shift its focus to features like price fluctuations and trading volume, and then shift back to broader trends as the market calms down. A truly responsive system.
And that automated feature selection, eliminating human bias entirely. That's key. No more picking indicators out of a hat. It's a significant improvement over trying to predict the future with yesterday's tools.
Absolutely. Imagine the time saved and the potential for fewer errors. By letting the data speak for itself without human intervention, you're virtually guaranteeing a more objective assessment. Plus, you can see patterns we may have completely missed before.
The ability to see the momentary and time-offset relationships is mind-blowing. This dynamic model could potentially uncover hidden influences in supply chains, for example. Imagine spotting those lead lag effects much faster than before, right?
Exactly. A real-time view of these intricate interactions could lead to more accurate forecasts. It's not just about the price going up or down, but understanding the why behind these changes. It's a much richer, more nuanced picture of the market.
So, this dynamic model isn't just about predicting prices. It's about understanding the why behind them. It's about unearthing these intricate connections in the market. That's a game changer, isn't it?
Absolutely. It's like moving from a simple snapshot to a dynamic, interactive map of the market. We're not just looking at the individual stock movements. We're seeing how those movements ripple through the entire system, how the connections influence each other. That's incredibly insightful.
And the real-time insights. That's the key to adapting to the ever-changing market. No more lagging behind. This is about being in the market, reacting to its pulse, not just responding to its echoes.
Exactly. A dynamic system that understands supply chains, economic signals, and investor sentiment in real time. It's not just about prediction. It's about understanding the forces that shape the market's behavior. That's a whole new level of insight.
So, we're moving beyond simple historical patterns and into a more complex, interconnected system. This is about actually modeling the market's behavior in a dynamic way, rather than just relying on past data.
Precisely. A market-aware system that reacts to live information. Think of the potential applications: more accurate risk assessments, better portfolio management, more intelligent trading strategies. This is a paradigm shift, a truly transformative approach to stock forecasting.
So, these momentary and cross-time correlations, that's the real magic, isn't it? It's not just about stocks moving in tandem, but about understanding how one stock's action can trigger a response in another, even hours or days later. It's like a chain reaction.
Absolutely. It's a dynamic, interconnected web. Traditional models miss these crucial lead lag effects. Take a supply chain disruption. The upstream supplier's stock might jump immediately, but the downstream manufacturers might only react later when the shortage hits their production. Seeing that connection is essential.
And it's not just about supply chains. Think about a major policy announcement. One sector might react instantly, while another might lag behind as analysts and investors assess the broader impact. That kind of nuance is key.
Precisely. This is where the potential for significantly improved predictions comes in. By recognizing these time-sensitive connections, we can potentially spot impending price movements in downstream companies, or even identify sectors that are likely to be affected by a policy change before they show any visible signals.
It's a more sophisticated understanding of cause and effect in the market. It's not just reacting to price changes, it's understanding why they're happening. That's a powerful distinction.
Absolutely. We're moving from a basic, linear view of the market to something far more complex, but also potentially more accurate. By looking at these lead-lag effects and how different stocks respond to the same stimuli, we can build a more comprehensive and dynamic picture of the market's true behavior.
So, this dynamic feature selection is crucial, right? It's not just about picking the right features, it's about understanding when those features matter most. Imagine oil prices spiking. Different factors become crucial then, compared to a stable market.
Absolutely. It's like having a real-time filter. In a volatile market, price fluctuations and trading volume become key. In a steady market, long-term trends like moving averages might be more important. That adaptability is incredibly powerful.
And the model does this automatically. No more guessing or manual adjustments. The model itself learns what's significant in real time, responding to the market's pulse. That's freeing up human analysts for higher-level tasks.
Exactly. It's not just about using the right tools, but about using the right tools at the right time. The model learns what signals are most relevant for this market condition. This level of automated adaptation is a massive leap forward.
It's like the model is actively learning about the market's behavior and evolving its strategies. This is not just about forecasting. It's about understanding the underlying drivers of stock movements. It's like having a sophisticated internal market radar.
Precisely. It's a real paradigm shift. Instead of relying on static rules and old data, we can now capture the nuanced, real-time signals that truly shape the market. That's what truly sets this approach apart.
So, this dynamic feature selection, it's not just about picking the right indicators. It's about understanding when those indicators are most useful, right? Like in a bull market, trading volume might be huge, but in a bear market, things like company fundamentals take center stage. It's all context dependent.
Exactly. Think of it as a constantly adjusting lens. Right now, market volatility might be the most important factor, so the model boosts the importance of related features. When the market calms down, it shifts to other things like long-term trends. It's really intelligent.
And the gating mechanism is the key, isn't it? It's like the model has a built-in sense of what's crucial at any given moment, automatically adjusting which factors are given the most weight. It's impressive how it picks up those market cues.
Absolutely. That adaptability is essential. It's not just predicting the price. It's understanding why the price is moving the way it is in this current market environment. Imagine the difference between a smoothly rising market and one with sudden, sharp swings. The model needs to react accordingly.
So, this dynamic approach frees us from having to manually adjust our models all the time. The model effectively learns the market's behavior, and this is what distinguishes it from older approaches. It's not just about adjusting the model. It's about letting it learn the appropriate indicators at any given time.
Precisely. It's a more natural, more sophisticated way to predict stock movements. This dynamic adaptation is the key to more accurate forecasts across all market phases. We're moving beyond simplistic models to one that truly understands the complex, real-time interplay of market forces.
Okay, so this model isn't just predicting prices, it's actually trying to understand the market, right? It's not just about when two stocks are linked, but also how and why. That's a significant leap.
Absolutely. It's like having a detective investigating the market. It pinpoints when stocks are closely tied, traces the delayed connections like in a supply chain, and even figures out why certain sectors are reacting in a specific way during a certain market phase. That's crucial for deeper insights.
And the example of defensive sectors during uncertainty or growth stocks during a bull market, that really highlights the model's adaptability. It's not just a generic prediction. It's a tailored understanding of the current market environment.
Exactly. Imagine a sudden shift in investor sentiment. This model would pick up on that, adjust its feature selection accordingly, and offer a more accurate forecast than a model relying on static rules. is a crucial aspect, truly understanding and responding to the dynamic market.
So, it's not just a predictive tool, it's a diagnostic one too. It tells us at this moment, these factors are most important. That's something truly invaluable.
Absolutely. It goes beyond simple forecasting. By analyzing the underlying drivers, it allows us to truly understand the intricacies of the market, rather than just reacting to movements. That knowledge is invaluable for strategizing and making better decisions.
Okay, so this gating mechanism, it sounds crucial. How does it actually decide which features are important at any given time? Is it like a weighted scoring system?
Yes, exactly. It looks at real-time market data like the market index and volume. The higher the score a feature gets, the more important the model thinks it is for predicting future price movements in this market context. It's a sophisticated algorithm that's constantly learning and adapting. Think of it like a dynamic filter that zeroes in on the most relevant information.
So, if the market is experiencing high volatility, features like price fluctuations will get a higher score, and the model will prioritize them in its analysis, right? Makes sense. How does that differ from a model using static feature selection?
Precisely. Static models use the same features all the time, regardless of the market environment. This dynamic model is much more flexible. It's constantly evaluating the market conditions and adjusting its focus accordingly. That's the real power of the adaptability here. It avoids relying on stale indicators that might have worked in the past but are now useless.
Okay, so this gating mechanism is like a sophisticated filter, right? It figures out what's actually important in the market at any given time. How does it distinguish between, say, a temporary blip and a real trend?
Exactly. It's not just about spotting volatility. It's about understanding the context of the volatility. The algorithm learns during training what signals are truly meaningful in different market phases. Think of it like identifying the key ingredients in a recipe. Some are vital, some are secondary, and some are just added flavor.
In this intrastock aggregation, looking at each stock's history makes sense. It's not just about the price today. It's about the patterns in past behavior. How does a transformer-based encoder help with that?
A transformer encoder is like a highly sophisticated detective. It doesn't just look at individual data points. It understands the whole sequence. It identifies patterns and dependencies in the historical data, even across different time frames. So, it's not just looking at yesterday's price. It's seeing how that price relates to previous price movements and volumes over time. It finds hidden links, almost like a puzzle being solved.
So, this intrastock aggregation, it's about finding patterns within a single stock's history. How does this transformer-based encoder precisely figure out these patterns, like those steady price increases or sudden spikes?
It's fascinating. Think of it as a pattern recognition expert. The encoder doesn't just see isolated price points. It sees the entire sequence of price changes, volumes, and other features. It looks for connections, dependencies, and trends across time. It's essentially learning the unique story of each stock and its patterns over time, allowing it to predict future behavior. It's really about recognizing the story behind the stock's price action.
Okay, that's helpful. And the local embedding at each step, what does that exactly represent? Is it a snapshot of the stock's current state, considering its history?
Precisely. The local embedding is a concise summary of the stock's behavior at that specific moment. It takes into account all the information from its historical price movements, volume patterns, and other data to create this condensed representation, a detailed account of the stock at that particular time, which takes its past into account. This is a key part of why this method is so accurate.
Now, moving to interstock aggregation. You're saying it looks at relationships between stocks. Can you give an example of a cross-time correlation it might find?
Sure. Imagine a raw material supplier, stock A, and a company that uses that material, stock B. The model might notice that stock A's price spike before stock B's price changes, revealing a lead-lag relationship. It detects this cross-time correlation, even if the reaction in stock B happens days later. This is incredibly helpful in predicting future movements.
Okay, so this multi-head attention mechanism, it sounds like a powerful way to identify these correlations. But how does it actually assign weights to the other stocks? Is it like giving a higher weight to stocks that have historically moved similarly?
Not quite. It's more nuanced than that. It considers not just past similarity, but also the timing of the relationships. The mechanism looks at the context surrounding each stock's behavior at the specific moment in question. If one stock is exhibiting a certain pattern, and another stock shows a similar pattern just before or after, it assigns higher relevance, potentially even revealing a lead-lag effect. Think of it as a sophisticated filter for relevance considering time.
Right. So, you're saying it's looking for correlations that might be happening at a specific time, as well as looking forward or backward in time, not just in a single time period. How does this lead to a temporal embedding?
Exactly. The temporal embedding is a richer representation of a stock at that particular time step. It incorporates not only the stock's own history, but also the weighted relationships with other stocks at that moment, highlighting important interactions and lead-lag effects. It's a combination of the stock's internal behavior and its dynamic connections with others, capturing its position within the entire network of stocks. This really encapsulates the moment, considering its position within the overall market context.
Now, about this temporal aggregation. You said the model takes the most recent temporal embedding and uses it as a query. What's the purpose of this query? What's it looking for in the earlier embeddings?
The query, the most recent temporal embedding, is like the focal point. It's asking, what do the earlier embeddings tell me about this current moment? It's looking for patterns in the stock's past behavior that might help it understand the current situation and predict future movements. The attention scores assigned by the multi-head attention mechanism are then used to weigh the importance of those previous time steps, essentially giving more importance to relevant and influential historical periods, which is critical for predicting future trends.
Okay, so this attention scores thing, it's crucial. If a stock had a major move 3 days ago, why would the model assign it high importance? What's the reasoning behind that?
Because it's likely that event, whatever caused that 3-day-old price jump, still has reverberations. The model isn't just looking at the event itself, but also at the consequences of that event on the stock's subsequent behavior and its interaction with other stocks. It's like looking for clues in the stock's history. A significant past event might be a strong indicator of current and future trends. It's a way of understanding how past events shape the present.
Got it. So, the attention scores are basically like assigning weights to different historical moments based on their perceived relevance to the current stock's behavior and potential future price changes?
Exactly. High attention scores mean the model thinks that particular historical moment is highly relevant for predicting the current stock's future movements. Low scores indicate events that are less impactful on the current price action. It's not just about finding past similarities, but understanding why these historical events might be influencing the stock's current trajectory.
And finally, this prediction layer. What does it do with this final comprehensive embedding? How does it translate it into a prediction of future stock movements?
The prediction layer essentially takes that detailed summary of the stock's history and relationships and converts it into a forecast. Think of it as a final calculation. It's using the embedding to predict the probability of a price increase or decrease. The output is a quantitative prediction, like a return ratio or a percentage change, reflecting the model's assessment of the stock's likely future movement, based on the complete picture it has of the stock's behavior and its interactions with others. It's all about using the comprehensive information to quantify the probable future movement.
Okay, so this prediction layer, it's essentially a mathematical calculation, right? How does it use this embedding to predict future movements? Is it just a simple linear equation, or is there more to it?
It's not just a simple linear equation, although a linear function is often a good starting point. The critical part is that the embedding itself contains all the relevant information about the stock's history, its relations with other stocks, and the current market environment. The prediction layer uses this rich information to calculate a probability of a price increase or decrease. It's not just a simple projection. It's a sophisticated analysis based on the comprehensive embedding. Think of it like a final summation of all the factors contributing to the stock's future movement.
So, it's taking all that complex information and distilling it down to a single prediction like a return ratio or a percentage change. How does it account for the potential for error or uncertainty in those predictions?
Absolutely. The prediction isn't a guaranteed outcome. It's a probability. The model, through its learning, understands the likelihood of different price movements. It's not just about saying the price will go up, but rather there's an 80% chance the price will increase by X%. That includes incorporating the model's understanding of potential risk factors. This probabilistic approach allows for a more nuanced prediction, accounting for the inherent uncertainty in market fluctuations. It's about acknowledging that the future isn't completely predictable.
Right. So, the prediction layer is effectively weighing the probabilities of different scenarios and giving an informed estimate of the likely future direction. What about that last point, individual stock patterns and the broader market context? How does it account for that?
Precisely. The embedding includes information about both the stock's individual historical trends and its interactions with others within the market context. The prediction layer considers this combination to provide a forecast that reflects both individual stock behavior and broader market trends. So, a prediction for a specific stock isn't isolated. It's integrated into the overall market picture. You're getting not just a prediction for a single stock, but the relationship within the greater market context.
Okay, so this momentary and cross-time correlations idea, it sounds crucial for capturing the fleeting nature of stock relationships. But how does the model distinguish between a genuine relationship and a random fluctuation in price?
That's a great point. The model doesn't just look at a single price jump. It examines the pattern of the price movements and how these movements relate to other stocks. Statistical significance analysis comes into play here. For example, if a raw material supplier, like Company A, consistently sees price movements that correlate with a downstream manufacturer, like Company B, the model is more likely to identify that as a genuine relationship rather than just random noise. It's about finding consistent patterns, not just isolated events.
I see. So, it's not just about when the price changes, but also how the changes are related across different stocks. And this time offset aspect is crucial?
Absolutely. The time lag between the price movements of Company A and Company B is a significant clue. By identifying this lead-lag relationship, the model isn't just reacting to a news event, it's anticipating the market's response to it, and that's a significant advantage. It shows a deep understanding of how the market reacts over time.
And in the automatic feature selection part, how does it decide which features are most important right now? Is it just looking at current market volatility? What other factors are considered?
Not just volatility, although that's definitely a key factor. The model also considers trading volume, the overall market index trends, S&P 500, etc., and various other market signals. It uses a gating mechanism that dynamically assigns weights to different features. If the market is highly volatile, volatility-related features become more prominent. If the market is stable, long-term indicators might take priority. This is a sophisticated weighting system that shifts according to the current market landscape, not just a simple snapshot in time.
So, this gating mechanism, it sounds pretty sophisticated. How does it actually work? Is it just assigning numerical values to different features based on volatility?
It's more nuanced than just assigning numbers. The gating mechanism learns from historical market data, identifying patterns in how different features correlate with market conditions. It's not a simple rule-based system. It's a learned model that understands which features are most predictive in various market environments. Think of it as a dynamic filter, adjusting the importance of each feature in real time according to the current market sentiment and volatility. So, it's not just a simple numerical assignment, it's a complex algorithm that weights features intelligently.
Okay, that makes sense. But how does this intrastock and interstock analysis deal with the sheer volume of data? It seems like a lot of comparisons to make.
You're right, there's a lot of data. The key is the sequential nature of the analysis. The model breaks down the process into smaller chunks. First, it looks at the individual behavior of each stock intrastock to identify patterns within its own history. Then, it focuses on the relationships between stocks interstock at specific moments in time, not every single possible comparison. This step-by-step approach avoids analyzing every single possible stock time pair at once, making it computationally efficient and scalable for large datasets of hundreds or thousands of stocks. It's smart in how it tackles the massive amount of data, focusing only on the necessary connections.
So it's a bit like a filtering system, first looking at individual stock patterns and then narrowing down to specific stock correlations, saving computational power?
Exactly. It's a layered approach to identifying the most relevant data, similar to how you might search through a very large library. First, you find the section that interests you, the intrastock history, and then you focus your attention on the books that are related within that section, interstock correlations. This helps the model process vast amounts of data without getting bogged down in unnecessary calculations. It prioritizes relevant interactions and saves computational power.
That's very helpful. It seems like this method is designed to be scalable and adaptable. Is that correct?
Absolutely. The layered approach, combining intrastock and interstock analysis, allows the model to handle an enormous amount of data while focusing on meaningful connections. This architecture makes it highly adaptable to different market conditions and stock universes.
Okay, so this efficiency, handling massive datasets, is crucial for accurate predictions. But how does this layered approach really improve the accuracy of the forecast compared to simpler, more traditional methods?
It's the dynamic nature, combined with the real-time feature selection, that leads to greater accuracy. Traditional methods often rely on static relationships and average correlations over long periods. This model, on the other hand, pinpoints when and how stocks are related, identifying fleeting correlations, lead-lag effects, and the immediate impact of events, all of which traditional models often miss. This more nuanced view of the market leads to more accurate predictions, especially in rapidly changing situations. Think about it, catching the ripple effect from one stock's price movement on another, instead of just looking at average trends, is a huge improvement.
So, it's not just about speed, but also about precision, understanding the why behind the price changes, not just the what.
Precisely. The model doesn't just predict that a price will change. It predicts why and how that change is likely to occur. It digs into the underlying interactions between stocks, the supply chain relationships, the market sentiment triggered by news events, and the reactions of different sectors to economic changes. This deep understanding of cause and effect translates into more reliable predictions. Imagine being able to anticipate a potential domino effect, where a movement in one sector can trigger a series of correlated reactions in others. That's the power of this approach.
So, in essence, the accuracy improvement comes from its ability to detect both intrastock and interstock patterns in a dynamic, real-time manner, not just analyzing them in isolation, or just looking at average correlations, right?
Exactly. It's about combining the internal signals from each stock with the external connections between stocks, all within the context of the current market environment. By doing so, it's not just a forecasting tool. It's a real-time observer of the market's intricate web of relationships, generating predictions that are more aligned with the market's complexity. And that's why this improved accuracy is a game changer.
So, taking this lithium shortage example, how does this model actually connect the price jump in Company A to the predicted decline in Company B? Is it some kind of automatic cause and effect algorithm?
It's not a simple cause and effect algorithm, but a sophisticated analysis of correlations and time delays. The model recognizes that Company B's future performance is likely influenced by Company A's present behavior, not just by the current market conditions. By identifying the time offset correlation between the two, the model anticipates that Company B's production costs will increase, leading to a price decline. It's not just about recognizing a connection. It's about understanding the temporal sequence of the connection.
Okay, so it anticipates the delayed effect, the ripple through the supply chain. But how does it predict the magnitude of that decline in Company B's stock price? Is it just a proportional calculation based on the price movements?
No, it's more intricate than simple proportionality. The model uses the combined insights from both Company A's internal behavior, the price spike and the underlying reasons, and the historical relationship between upstream and downstream companies, like Company B. It also considers other factors like market volatility, investor sentiment, and even broader economic trends. By understanding the specific context and relationships, the model can build a more accurate picture of the likely impact and adjust its predictions accordingly. Think of it as a sophisticated system for understanding the chain reaction of events, not just a simple prediction based on linear relationships. It's a complex picture built by taking different parts of the puzzle and fitting them together.
So, this is more like a complex systems model than a simple linear regression?
Absolutely. It looks at the whole picture, the interplay of internal company performance with broader market conditions, past relationships between companies, and the likelihood of a delayed reaction. Traditional methods often miss these subtle time-lagged connections and the nuance of the overall market conditions, leading to less accurate predictions. This model, however, attempts to capture the whole picture, giving a much richer and more reliable forecast. It's not about a single formula. It's about seeing the connections and drawing inferences from the combined data.
Okay, so this lead lag effect, company A reacting first, then company B later, is key. But how does the model actually detect these time-delayed relationships? Is it just looking for correlations across time intervals?
Not just time intervals, it's more sophisticated than that. The model uses advanced techniques, likely including a form of time series analysis, to identify patterns where one stock's price movements precede another's. It's not simply a matter of correlation. It's about spotting the temporal sequence of the relationship. Think of it like identifying cause and effect, where the cause, e.g., Company A's price jump, precedes the effect, Company B's price drop. It's looking for patterns of lead and lag, rather than simply looking for simultaneous movements.
So, it's not just about noticing that two stocks move together, but about understanding the order in which they move? That sounds a lot more nuanced than traditional methods.
Exactly. It's crucial to understand the sequence of events in the marketplace. Traditional models might miss this critical aspect of the market's dynamic behavior. By capturing this lead lag effect, the model gains a deeper understanding of how the market reacts to news and events, giving a much more accurate prediction of future movements. It's not just recognizing a relationship, it's recognizing the specific timing of that relationship, the lead and the lag.
Okay, so you're saying the model needs to build a more sophisticated picture of when a particular relationship happens and how its timing affects the outcome.
Exactly. This is where the real power lies. Instead of just seeing general correlations, the model can see the order of actions, anticipating the ripple effect that might impact other related stocks, not just the immediate effect on the supplier company, Company A. This leads to better, more accurate forecasts, helping investors make more informed decisions.
So, by accounting for these time-lagged relationships, the model can help investors anticipate how a particular event might affect the entire supply chain, not just the immediate participants?
Precisely. By understanding the sequence of actions, the model can effectively identify and anticipate those ripple effects that propagate through the market. That's how it moves beyond the limitations of traditional models that simply analyze stock movements in isolation. It helps to form a richer and more comprehensive understanding of the dynamic interplay between stocks and the overall market environment.
Okay, so this real-time aspect is crucial. If a mining stock jumps on resource shortage news, how quickly can this model react and identify the downstream impact on related companies? Is there a specific time frame for this rapid response?
The speed of reaction depends on the model's architecture and the data feed. Ideally, it should be near instantaneous once the market data hits the system. The real-time processing allows the model to detect the initial reaction, understand the connection to other companies, and then predict subsequent price movements with minimal delay. It's about recognizing that the market isn't static. It's constantly evolving, and quick response is key to capitalizing on those changes.
So, imagine a situation where there's a sudden, unexpected regulatory change impacting an entire sector. How does the model account for this rapid and unexpected shift in market behavior? Does it require retraining, or can it adapt on the fly?
The model's dynamic feature selection is designed to handle this. It should be able to identify the new regulatory change and adjust its emphasis on features associated with the impacted sector. It might quickly increase the weight of regulatory-related factors, while reducing reliance on historical industry averages or other factors that are now less significant. The gating mechanism is key here. It prioritizes the newly relevant factors without requiring extensive, time-consuming retraining. This adaptability is crucial for unforeseen market shocks.
That's interesting. So, not only is it identifying the lead lag effects, but also it's learning what's actually important in real time. How does this adaptability translate into better investment strategies for investors?
Investors can use this to identify short-term opportunities and manage risks effectively. If the model predicts a stock decline in a downstream manufacturer due to supply chain disruptions, they can either hedge their positions or look for alternative investments in related companies that may fare better or are less impacted. The real-time, dynamic insights provide valuable information for quick reactions, potentially allowing them to profit from market shifts before they become widespread. It's about being ahead of the curve, essentially.
Okay, so this automated feature selection sounds promising. But how does the model actually decide which features are most important at any given moment? Is it just picking the ones that correlate most strongly with current market conditions?
No, it's more nuanced than that. The model likely uses a sophisticated weighting mechanism, potentially a gating function, to adjust the importance of each feature based on the current market conditions. It's not just about correlation. It's about identifying features that are predictively relevant given the current market state. It takes into account not just the current market volatility but also the historical performance of the features in similar situations. This dynamic weighting system ensures the model's focus remains on what's currently driving price movements, not just what has worked in the past. It's about pinpointing real-time signals.
So, it's not just about selecting the features that show a high correlation with the market's current state, but the features that are most likely to predict future stock price movements accurately?
Exactly. It learns the predictive power of each feature in different market environments, so it dynamically prioritizes those that consistently offer insights into future price movements. This is crucial because the effectiveness of indicators like trading volume or price-to-earnings ratio shifts dramatically based on market conditions. By dynamically adjusting feature importance, the model can accurately reflect the real-time dynamics of the market.
That makes sense. So, this flexibility not only helps analysts save time, but also ensures more accurate analyses, right?
Absolutely. It empowers them to understand the why behind correlations, rather than just focusing on the what. They can identify the specific market factors driving price movements in each situation, whether it's a sector-specific event or broader market trends. This deeper understanding translates into more effective and reliable investment recommendations, and, crucially, strategies that adapt as market conditions change.
This adaptability sounds crucial for analysts dealing with large volumes of data. How does this model scale to handle the massive amounts of data associated with thousands of stocks and their interactions?
The model's architecture is designed for scalability. Its approach to analyze intrastock and interstock data separately greatly reduces computational demands. This approach efficiently processes vast amounts of information without becoming computationally overwhelming. It doesn't need to analyze every stock pair at every moment. It smartly targets the most likely relationships and analyzes them in real time. Think of it like a well-organized, efficient workflow instead of a chaotic, unfocused analysis.
So, this approach doesn't just make analysis faster, but it also unlocks deeper insights into the workings of the market by highlighting hidden relationships, providing an enhanced understanding of how stocks react to events and market conditions. This would prove to be very effective for analysts, right?
Precisely. It's about moving beyond surface-level correlations to a deeper, more predictive understanding of the market's complex dynamics. This allows for strategies that react to real-time signals and anticipate the impact of various factors, rather than relying on outdated assumptions and potentially flawed data. This is a game-changer for both analysis and investment strategy.
Okay, so this scalability aspect is key. How does this model handle a rapidly expanding stock universe, potentially including new companies going public or existing ones undergoing significant restructurings? Does it require a complete overhaul each time, or can it adapt smoothly?
The model's modular design allows for seamless integration of new stocks. By analyzing intrastock patterns first, it doesn't need to recalculate everything from scratch when a new stock enters the market. It can quickly incorporate the new data into its existing framework, focusing on the relevant features and relationships without disrupting the overall process. It's about incremental learning, adding new pieces to the existing puzzle rather than rebuilding the whole thing each time. It's highly adaptable.
That sounds efficient. But how does it account for emerging sectors with little historical data? Can it still identify meaningful relationships and make accurate predictions in these unknown territories?
Absolutely. The model's adaptability comes into play here. While historical data is crucial, it leverages real-time market signals and features to quickly identify patterns in emerging sectors. By looking at general market trends and focusing on relationships with established comparable companies, it can still make informed predictions based on the interconnectedness of the market. It's less about relying solely on historical data from the new sector and more about using related information to build a picture and understanding. This approach is what allows it to excel even in less mature or new markets.
So, it's not just about processing more data. It's about using the data intelligently to predict in those areas where historical data is lacking.
Precisely. It uses a combination of real-time signals and inferred relationships to fill in the gaps. It's not just about throwing more data at the problem. It's about being intelligent in how the model analyzes that data and creates predictive models in situations with less historical precedent. This approach allows it to make predictions that are both insightful and useful in these less understood market segments.
That's quite impressive. It seems like this model could really revolutionize how financial institutions and trading firms approach investment strategies, risk management, and automated trading platforms. What are the potential benefits for these organizations?
Huge. Imagine automated trading systems that can react to market events in real time, adjusting strategies based on dynamic correlations and feature importance. Risk management would become far more nuanced, anticipating sudden shifts and emerging risks in a fraction of the time. The potential for greater efficiency and reduced human error is vast. This approach positions financial institutions to stay ahead in today's fast-paced market environment and reduces errors related to reliance on historical data. It helps them make better decisions faster with reduced risk.
So, this real-time adaptability sounds crucial. How does the model actually react to, say, a major news event that suddenly shifts market sentiment? Does it instantly recalibrate its entire system?
No, it doesn't need a complete overhaul. The model's gating mechanism, which prioritizes features based on current conditions, is crucial here. A major news event would trigger a real-time recalibration of feature weights. The model would likely identify the relevant features immediately, perhaps emphasizing volatility indicators, news sentiment, or sector-specific signals, and quickly adjust its predictions accordingly. It's a dynamic response to the instantaneous impact of that news. Think of it as a well-tuned instrument adjusting to a sudden shift in the environment, responding instantly without needing to be reconfigured from the ground up.
That makes sense. A swift recalibration instead of a complete retooling. But how does it assess the impact of the news event, especially if it has complex, multi-layered repercussions?
Exactly. The model, through its attention mechanism, would not only identify the relevant features but also understand the connections between those features and different stocks. It would assess the ripples, not just the initial shock. For example, it would quickly pinpoint which stocks are closely related, in the same sector or even tied through supply chains. The multi-layered impact would be reflected in how those connected stocks are weighted. The model essentially maps out the cascading effects of that news event on the overall market structure, allowing for a comprehensive understanding of the ramifications, even if the event is unforeseen.
So, the model doesn't just react to immediate changes. It anticipates how those changes will reverberate through the interconnected market, enabling more accurate and nuanced predictions in the face of rapid shifts in sentiment and conditions.
Precisely. It's about predicting the downstream consequences, not just the initial shock. By combining this dynamic real-time analysis with its efficient and scalable architecture, the model moves well beyond static forecasts to deliver actionable predictions that adapt and adjust with the market, and, crucially, in response to a wide range of market conditions and complexities. This is a step forward in the sophistication and accuracy of stock forecasting.
So, this adaptability and responsiveness are key. This model is really focusing on understanding the why behind stock movement, rather than just predicting the what. What are the implications of this for the wider financial world?
The implications are profound. Financial institutions will be able to react more swiftly and strategically to market events. Imagine investment strategies that adapt in real time, dynamically adjusting portfolios based on the model's insights. Risk management systems can proactively identify emerging risks, and this adaptive prediction system allows for a more nuanced understanding of risk factors and a reduction of potential losses. The entire financial ecosystem benefits from a much more agile and informed approach, allowing for improved and more effective allocation of capital. Furthermore, the use of this type of technology allows for more accurate predictions and a more effective use of financial resources, potentially increasing financial stability and efficiency.
So, this dynamic, market-aware approach really opens up new possibilities for investors and financial professionals. What opportunities does it create for them, beyond just improved predictions?
Beyond just predicting price movements, it enables a deeper understanding of why those movements occur. Imagine investors not just reacting to a price drop, but proactively identifying the underlying factors, whether it's a supply chain disruption, a shift in investor sentiment, or a regulatory change. This deep understanding leads to more informed investment strategies, helping them make choices that are both timely and strategically sound. Financial professionals can use this detailed analysis to better advise their clients, offering insights that extend beyond simple price targets. It's about proactive strategy, not just reactive responses.
This proactive approach also seems to be key for financial institutions. How might this impact their risk management and decision-making processes?
Risk management will be transformed. Instead of relying on static models that miss sudden shifts, the model can track emerging risks in real time. This dynamic approach can also help in identifying and managing correlations between various assets more accurately. For example, it would help identify cascading risks, how a decline in one sector might affect others, enabling financial institutions to take more appropriate measures to reduce vulnerabilities. It's about preventing crises before they unfold through proactive risk management strategies.
It seems like this model could revolutionize the entire investment landscape, helping people make better, more informed financial decisions. But are there potential downsides to consider? What are the possible pitfalls or challenges of this approach?
Of course, there are considerations. The complexity of the model needs careful implementation. It hinges on the quality and quantity of data. Inaccurate or incomplete data can skew the model's predictions. Also, over-reliance on automation could lead to a loss of human judgment. There needs to be a careful balance between algorithmic insights and human expertise. Another challenge might be the potential for manipulation of market sentiment by malicious actors, as models like this could be affected by market manipulation. Constant maintenance and updates for the model will also be important to prevent obsolescence and inaccuracies. While this approach is sophisticated, robust validation and oversight are essential to prevent unintended consequences and maintain public trust.
Okay, so we've established the benefits, but what about the practicalities? How do you actually implement a system that dynamically adjusts to market changes? What kind of infrastructure is needed?
Implementing such a system requires a robust and scalable infrastructure, capable of handling enormous datasets and real-time computations. It needs high-speed data feeds for current market information, including stock prices, trading volumes, news, and economic indicators. This infrastructure must be highly reliable and resilient to ensure consistent data flow. Sophisticated algorithms need to be developed and implemented that can identify and analyze correlations, process data in real time, adjust feature weights dynamically, and generate forecasts promptly. The system also needs to be designed for scalability, capable of handling an expanding number of stocks, time steps, and new market factors. Think advanced cloud computing, powerful servers, and specialized software for data processing and model management.
That infrastructure sounds demanding. How can the model be validated and tested in a way that reflects the complexities of the real market? What are some real-world testing scenarios we can consider?
Validation is crucial. Testing needs to be done in several ways, starting with controlled experiments using historical data. These experiments can simulate various market conditions: bull markets, bear markets, crises, and periods of high volatility. Comparing the model's predictions with actual market performance under these diverse scenarios would provide valuable insights. Also, testing with simulated news events, analyzing how the model interprets and responds to different types of market shocks, is critical. Further, collaborating with financial institutions, particularly trading desks or investment firms, could provide real-world testing and feedback. Real market data can be used to see how accurately the model identifies lead-lag effects, anticipates market turns, and adjusts to market sentiment shifts in a way that reflects the overall market conditions. This combination of controlled experiments, simulated scenarios, and collaboration with experienced stakeholders will provide the most comprehensive testing possible.
So, the testing process should encompass not only hypothetical scenarios but also real-world, practical applications. This validates the model's capabilities in handling the dynamism of the real market, rather than relying solely on abstract metrics.
Absolutely. It's about ensuring the model is not only theoretically sound but also practical in its application to real financial decisions. Only by rigorously testing it in a way that closely reflects real market conditions can we have the confidence to use it for actual trading and investment strategies.
Okay, so we've discussed the potential benefits and challenges. But what about the ethical implications? This level of market analysis raises questions about potential manipulation and fairness. How do we ensure this powerful technology isn't used for nefarious purposes?
You've hit on a crucial point. Transparency and regulation are essential. Any system that can predict market movements with this level of accuracy needs safeguards. Robust regulations would be crucial to prevent misuse, like manipulation of market sentiment or exploiting vulnerabilities. The data sources used in the model must be transparent to allow for scrutiny and prevent bias. We need independent audits and oversight committees to ensure responsible use. Public forums and consultations are essential to gather perspectives on the ethical considerations from the financial community and public, too. The model's algorithms should be open to independent review to build trust and accountability.
That sounds complex. How can we balance the potential benefits of this dynamic approach with these crucial ethical considerations? Is there a way to strike a fair balance?
Yes, it's about finding a balance between innovation and ethical conduct. We need to develop a framework that allows for the advancements in this technology while addressing the potential risks. Think strong regulatory oversight and stringent guidelines, coupled with ongoing research and development into ways to make the system more resistant to manipulation or malicious actors. Education and awareness campaigns are equally vital to equip investors and the public with the knowledge to understand how this technology works, its limitations, and the potential ethical considerations. We need continuous dialogue among experts, regulators, and the public to ensure responsible development and deployment of these systems.
Okay, so we've established the need for a robust infrastructure and rigorous testing. But, practically speaking, how do we ensure this dynamic model can adapt to a constantly changing market landscape? What are the key considerations for maintaining its effectiveness over time?
Maintaining effectiveness is crucial. The model needs continuous learning. This means incorporating new data sources, constantly updating the model's algorithms, and adapting to shifts in market sentiment, economic trends, and even geopolitical events. We need a feedback loop to adjust the model's parameters in real time based on the accuracy of its predictions. Regular model retraining on fresh data is vital. This involves tracking the model's performance, identifying areas where it's falling short, and using that information to improve future predictions. Think of it like a living organism that adapts to its environment. Ongoing monitoring and maintenance are essential for long-term reliability. We also need to anticipate changes in market structure or data availability.
That sounds like a lot of ongoing work. How do we balance the need for continuous adaptation with the need for stable, reliable results? How can we build in flexibility without sacrificing the model's predictive power?
It's a delicate balance. We need to incorporate mechanisms for monitoring and adjusting the model's responsiveness to changing conditions without causing instability. This might involve a tiered approach, where some adjustments are made swiftly to react to immediate market shifts, while others are more cautious to avoid overreaction to transient fluctuations. Perhaps incorporating a system for identifying significant shifts in market behavior and triggering more intensive retraining only during those crucial moments would be beneficial. Essentially, we need to balance speed and agility with stability and accuracy in our adaptation methods.